Hi, I'm Jim Cramer, and I'm here with our energy expert, Dan Dicker, who has just been red hot. Dan, here we go. Oil back to 40, 41.
Exactly.
Everyone's telling me, here we go, going back to 30 again every time we get here.
Wrong. We sat here when it was $47, $48. We said, don't get excited. This is a market that's bounded. It's bounded between 40 and it's 50. And what happens when we get down to 40, and we made up a chart of this, I wanted to make sure that people understand what happens. There's a momentum play that goes on in the shorts, and the shorts get very deep. And you can see this in this chart. The orange line represents the amount of short positions. The green line would represent the amount of long positions, and the white line in the center is the price of crude. Now, what you find is that there is a spike in the amount of short positions that has been happening right here, just as been happening in August. And when that happened in August, we got a spike on prices close to $60. Now, I'm saying that what we have is we have a momentum play going on that's pushing prices down. It's less fundamentally driven than people think. There's no reason in the world for a commercial player to sell crude oil at prices below $40 because it doesn't help them from a hedging point of view. And I tell you, the shorts will get caught again as they did recently. That doesn't mean it's going to $70. Right. I'm not on Boone's side. Right. But I tell you that if you are shorting oil and oil stocks here, you are making a mistake. These are the moments where you have to look at oil stocks, try and find some value, try and take some in for the long haul. This is the moment when you have to do that.
Okay, so RBN, an outfit that I use, Rusty Brazil.
Smart guy, Rusty.
He is saying, listen, the production is still pretty strong here. But that doesn't necessarily mean it has to take out 40, does it?
You know, this is the way I put it, and Rusty's smart, and he's right. The production has actually not dropped an ounce in a year. It really hasn't. But it's like turning a barge around. And what you have is you have a lot of oil that's been coming online from projects that were undertaken in 2012, 2013. Right. We've only just seen the CapEx get slashed to the degree it has now. We've only just seen the rig counts going down, the 1,100 rigs that it's gone down. And we've seen a huge increase in the efficiencies that have come out of the wells. Now, all of this has translated into a very slow kind of production drop so far, only down about 350,000 barrels from the height it was in April this year. But I think that this is the start, only the start of a rebalancing that's going on in the oil market. Everyone is looking for 500,000 barrels to drop in the U.S. production over the next year. I think it's going to be closer to 1 million. I think that no one is taking into account the number of Gulf of Mexico and other offshore projects that will not come online in 2016. A whole bunch of projects, for example, in Iraq, where seriously they've run out of capital expenditures to drill even in Iraq. The Saudis are at full tilt. There is a very, very slow turning around of the barge here.
Well, okay, so some of the stocks are reflecting that. Chevron is insanely high.
Exactly. That's exactly right. Look at stocks like EOG. The last time down we were at $70. Now it's at 83.
Didn't come in despite this decline. The futures guys are pressing their bet. And the common stocks are saying things are better than you think.
That's exactly the way I read it, Jim.
Well, that's the way I'm going to play it too, Dan. And I know last week's video's explosive, and I'm sure this one will be too. Thank you so much, Dan Dicker.
Thank you.